All right, we'll start with police. Tommy Blair.
Here.
I'm here. I'm present. Chris Kewen. Dan Ottavasio.
Here.
William Stanley.
Present.
Joseph Smith.
Here.
Okay.
On Fireside, AJ,
Present.
Latham,
Here.
I'm here, Dean,
Here.
Stephen Lee,
Here.
all present.
All right, public comment.
Nope.
Okay, no public comment. All right. Any comments on the minutes from December 4th? No?
Comments on the, no?
Motion to approve, right?
Yep.
Motion to approve? All in
second.
favor, say aye.
Aye.
First and second?
First, second.
Okay.
Aye.
Aye, all in favor.
Motion to approve?
Motion. Second. Motion, and second by AJ.
No, I'm getting old, but I'm not hearing,
All right, expenses paid. Any comments?
I had a question. Debbie, the IME fee, what was that again?
that's for the independent doctor.
Okay. It was abbreviated, so it. No further, any questions? No. No further questions.
Thank you.
Motion to approve the expenses paid. Second. All in favor?
Aye.
Motion to approve expenses?
Motion. On second.
Second. All in favor?
Aye.
Okay, we have
Carrie.
Ms. Carey with the Mariner Quarterly Report.
Thank you very much. Good afternoon and good to see you all. I will just flip right into your respective books, starting on page 3, where our typical market charts are there. And just say, this will probably not surprise anyone, but it was a very volatile quarter. So within equity markets here in the US, we started October kind of in a place where there was a lot of negative sentiment out there about the upcoming election, obviously lots of ugly rhetoric. And so markets were actually down in October. Then come November, we had pretty decisive election results to start the month. Some euphoria surrounding lighter regulations, and so markets were strongly up in November. And then we turned around and gave some of that back in December. I think the overall backdrop of the economy remains strong. GDP continues to surprise to the upside. The labor market is still pretty healthy, by most indications. The higher interest rates that we felt going back to 2022 and 2023 when the Fed started hiking have largely not broken anything. I think if anything, the economy's been a lot more resilient than what was expected. But what you saw through the end of the quarter was interest rates actually picking up over concerns that, inflation may be a little bit stickier than maybe we'd like. Things like tariffs could potentially put upward pressure on prices. The labor market, again, still very healthy. If you talk about all else equal, kind of deporting people and potentially cutting into the labor supply, that could put upward pressure on wages. And so we actually saw yields kind of picking up on the longer end of the yield curve, and I'll show you that when we get to our market chart. But kind of putting all that together, where we landed at the end of December, and I'm looking at our top right chart on page 3, is equity markets within the US were positive. It was another quarter where our Mag 7 really led the way. That kind of AI technology trade really led the way. So you can see the S&P was up about 2.5%, but as you move down the capitalization spectrum, kind of the mid and small caps, just really marginally positive. For a little perspective, I put this handout in your packets, or actually on the table today, and it's a chart of calendar 2024, and it shows you 3 data points. In black is the S&P 500 for the 1-year period, and you can see it was up just about 25%, which matches up with the bottom chart on page 3. You can see the S&P did about 25% for calendar 2024. On the blue line, we show you just the Magnificent Sevens returns, which were about double that, just about 50% for the 2 classes of Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And then if you drop kind of to the bottom of that page in orangish yellow, that is the S&P 500 taking those 7 names out. And you can see without those 7 names, the S&P did about 16%. So it just kind of goes to show you, that, again, this is just a 1-year period. This phenomenon has been in place for the last several years, but how much those kind of few names continue to contribute to the performance of the S&P. In the box on the far right, it shows you for the full year, bless you, for the 25% that the S&P 500 did, how much each name contributed to that. So of the 25% we got from the S&P, about 13.5% of that was just from those 7 names. And NVIDIA is really the one that kind of jumps off the page at about 5% of that 25. So what we call narrow market leadership, which is just a fancy way of saying, you know, those few stocks have continued to drive performance, was the case at the end of the year as well. It seems like there's room for kind of those other, call them 493 stocks to sort of differentiate themselves a little bit. This kind of AI trade has been very long in the tooth. You know, again, seems like things might reverse at some point. Hard to very accurately say when, but the index is really more concentrated than it's ever been, both from an individual holdings standpoint and from a sector standpoint, meaning, you know, technology itself of 11 sectors in the S&P is over a third of the S&P. So just kind of giving some additional color to kind of that narrow market leadership that we've talked a lot about there. Within international equities, back on page 3 again, in kind of the yellowish orange bars, you can see pretty much all of the indices right around -7.5 or 8%. Anytime you start talking about tariffs, that's going to be negative for particularly Western Europe, obviously Canada, Mexico, et cetera. And so that general theme really weighed on overseas equity markets. And then in the bottom third there, you see the aggregate down about 3%. And if we flip to our old familiar yield curve chart, you can see the visual on that on the bottom of page 10. Just kind of giving some visuals to what I spoke about, kind of interest rates picking up there. We did get some cuts from the Fed in 2024, which brought the front end of the yield curve down. And I'm looking at the bottom of page 10, that blue line. You can see where it kind of drops down on the left-hand side as compared to the orangish yellow line. But then you see really across the longer term maturities, it really starts to pick up. And that's that steepening I was talking about, you know, markets pricing in concerns, you know, that growth might be more than expected, which is a good thing. But again, that inflation piece playing in there too. So I talked a little bit about volatility within equity markets, but really interest rates were very volatile through the quarter too. To give you a little bit of a perspective, the 10-year Treasury, which is kind of 3 in from the right side on that graph, moved 84 basis points through the quarter. It started kind of 370s-ish range and ended the quarter around a 450. So the 10-year Treasury moved almost a full % just over the course of 3 months, which is really pretty significant. One good thing to note, though, is as we look at that blue line, we've talked for several quarters about this inverted yield curve phenomenon, which means there was a period of time where you could earn more on a 2-year Treasury than you could on a 10-year Treasury. Historically, that's been a pretty accurate predictor of a recession to come. That is no longer inverted. If you look at the 2-year and the 10-year now, you can see there's kind of a slightly upward curve there. So no longer seeing that kind of flashing recession indicator there. That 2 and 10-year yield curve inversion has corrected itself. The very short end of the curve, kind of 1 month, 3 month, remains a bit elevated. But if we do get a cut or 2 in 2025, which is possible but not guaranteed, you know, that may fix some of that. We may start to get kind of a more normally shaped yield curve there. One other thing I'll mention is separate real estate. You'll see as we get into the results. This was the second quarter in a row that we did have a marginally positive return from that index. I don't want to get anybody too excited, but marginally on the order of about 1% positive. within that real estate index. I think if rates kind of stay where they are, or if they do settle down a little bit, that's going to be, better, kind of a more productive environment for real estate. Obviously, if they go up from here, that's going to be a challenge. Don't want to fully call the recovery yet, but just saying we are seeing some green shoots there, so kind of cautiously optimistic about what 2025 may hold for that space. Any questions on the economics piece before I move into the pensions themselves? Okay, I think hearing none, I'll move to 13 in your books, our kind of 10-year look back in growth of your funds. And just starting with police, you'll follow that blue line to the right-hand side. You can see you all were a shade over 19 million to end the quarter. It was about 19 million, call it 57,000 in market value. Fire, you all were about 19.4 million, specifically 19 million, about 388,000. Both of you in kind of that 7.1-ish% return range for the 10-year period. If you'll recall, when we saw Doug last quarter, 7.2 was used in your assumption, so on a 10-year basis, pretty much right on top of that. Obviously, real estate has definitely been a challenge over the last couple years, but very happy to say those longer-term numbers, again, still pretty much right in line with the assumptions that we're making. Flipping ahead just to kind of the high-level view of your assets in each respective pension fund, starting with police. You were just at about 50.5% in U.S. equity. You were just over 14% in international equity, a shade over 17% in domestic fixed income, rounding up a bit north of 4% in global fixed income, just shy of 11% in real estate, and then a little bit of cash as well, about 3% in cash for you on the police side. On the fire side, very similarly, you were just a shade over 50% in domestic equity, 14.5% in international equity, about 17.5% in U.S. fixed income, just over 4% in global fixed, about 10.5% in real estate, and again, about 3% in cash for your plan as well. So that's kind of the high-level snapshot. And then if we move from there a few pages up to page 19, it's kind of a better view on a relative basis where your asset allocation is. Suffice it to say, each plan is within your investment policy targets. Both funds pretty much right on the nose from a domestic equity standpoint. Same thing for international. Slightly overweight domestic fixed income, offset slightly underweight in global. Both underweight within real estate, and again, well within range there for cash. And I will stop there and say, again, with one plan at just shy of 11% in real estate and the other at about 10.5%, we've got that target of 15. We're getting close to the ability to have a conversation about what that space looks like going forward. Typically with managers in this space, the minimum commitment size that we see is about $1 million. So we're kind of getting close to being underweight that in each of your funds. One of the things I would like to host a discussion for at your next meeting is actually real estate debt strategies. So right now, what you all have with ASB is more of a real estate equity strategy. So buying properties predominantly with cash, using a little bit of debt. There are managers out there now that are making loans against commercial real estate holdings that tend to be very highly collateralized, and the yields right now are kind of in the 10 to 13% range. So that space looks pretty attractive right now, and there's not a lot of players in it, so those that are kind of making those loans are able to dictate pretty attractive terms. So again, as we approach the ability to consider about $1 million commitment to something different within real estate, I would like to host that conversation with you all. We'll kind of do some education and also show you some managers that we follow in that space for discussion in May. But really, in summary, leaving page 19, just want to leave you with the knowledge that, very comfortable with where you are at this point in time, so not making any recommendations there for you all to rebalance. Moving ahead and putting some numbers on that volatile quarter that we spoke of, I'm on page 22 for each of the funds. And each of you kind of marginally down for the quarter, right around 20 basis points for each plan, slightly better than your benchmark overall, which was down closer to 40. As we mentioned, the strength really coming from your domestic equity segments, particularly within kind of the growth side, and you'll see that as we get into the manager performance. But on the U.S. side, positive, just shy of kind of 2.5%. The index was up about 2.6. Again, the growth side really responsible for kind of the absolute numbers that were put up for the quarter. Winslow, you can see, was up a little shy of about 5%. The growth index actually did 7%. So not holding Tesla and necessarily kind of market weighting the other Mag 7's a little bit of a drag. Also, one of their pharmaceutical names, Eli Lilly, a little bit of a drag there. Again, we're definitely waiting to see kind of some broadening in participation, especially in that growth space. Touchstone in the mid-cap growth segment, pretty well in line, up about 7.5. The index was up a little bit more than 8. So a little weakness in consumer discretionary and healthcare there for the quarter, but again, pretty well in line. Those growth pieces doing well was a nice offset for the value piece, which was slightly negative. Within value, Vanguard Equity Income did hold up a little better for you. They were negative less than 1%. The index was down about 2. Some of their selection in utilities and consumer discretionary actually helped them. And then on the other side, Brandywine, slightly down more than 2%. They will do a select amount of kind of energy and industrials. Marathon in particular was down a bit, Lockheed, some of the others down a bit. Still like them long-term, they just had sort of challenging quarters. And then, of course, you have the extended market index as well, which was up about 4.7 there for the quarter. On the next page, just looking internationally, again, that segment largely negative. I will say you did about 1% better kind of in total there. Your segments respectively were down about 6.5%, but the index was down about 7.5%. That kind of more defensive DFA international value, very kind of low PE, more kind of traditional, financials, industrials, focus on those value-oriented sectors, holding up a little bit better than Euro-Pacific on the growth side, but again, both of them doing better than their indices for you together. Within fixed income, overall, we were down just about 2.5%, a little bit north of that. Most of that coming from your domestic segment. Dodge and Cox down a little over 3. The index was down about 3. So good quarter for corporate credit where they tend to overweight, but they have been a little bit long rates, and so that did hurt them. But that was actually offset somewhat by the global piece. PIMCO Global Bond has actually been short, so they were overweight to the short end of the yield curve, which definitely helped them. They were only marginally negative there for the quarter. And then within real estate, as I mentioned, very small numbers, but kind of marginally positive there. As it relates to ASB, you continue to get distributions. They're still kind of trickling in. We got about 16,000 last quarter. It was a little bit higher this quarter. I think they're seeing transactions pick up, and they've said they've got about 1/3 of the portfolio, ready to market. So I do think we'll continue to see some liquidity from them, barring some sort of unexpected, kind of market event or interest rate event. I do think that will start to speed up here in 2025. The good news is they did pull off about $500 million in dispositions in 2024. They've used some of that to pay down some of their debt. But again, I do think, the positioning right now looks much better. They're about 10% office, less than 8% retail, very heavy industrial and multifamily. Those two sectors are about 2/3 of the portfolio right now. So I do think that will help them as they continue to reposition and cash out investors like you all. So that is 12/31, which was, again, kind of volatile and slightly negative. Interestingly enough, we had a positive January, pretty positive actually, and there are market value updates for each fund sitting in front of you. So police, you ended January with slightly over $19.5 million, about $19,545,000. And fire, you were really kind of on the heels of $20 million, about $19,895 as of the end of January. I think we probably expect to see some of the volatility continue. The tariff conversation, obviously markets did not like that early yesterday, and then when it was decided that we were going to kind of come back to the table and maybe make some concessions, we sort of pulled back in some areas. So I think, the volatility will continue, but that said, you're positioned very well. I think we have a good roadmap going forward. And likely as of the end of January, you are positive a couple of percent. The S&P was up about 3. The growth index was up about 2, even fixed income was marginally positive, about 0.5%. So let me take a breath there and see what questions you all might have. Dan?
Terry,
Yes.
we had talked about, or we had, I thought, some of our real estate up for sale, and we had to wait until they found a buyer.
Yes.
Is that all done, or are we still?
It's still in process. They've done some. So for about a $6.2 billion fund, they sold about 500 million in properties last year, and they've got about 1.4 billion going online, they expect this year. So we've gotten a little bit of cash back. What happened was, typically funds use a certain amount of leverage. In this space, it's usually about 20%. As the property values come down some though, that leverage level comes up. So they went from about 20% leverage to about 30. So they've taken some of the cash from those dispositions to pay off some of that debt. But that said, I do think that process of selling properties and returning money back will speed up in 2025 based on what they've got lined up for sale. And the fact that they actually were able to sell quite a bit of office properties over the last couple of years. So they were at about 22% office at the end of 2022. They're at about 11% now. So they have been able to make kind of some significant moves in that area. But you're not seeing it as much as I wish you would because they did pay some debt down because the leverage has popped up some.
Well, I guess my next question follows up on that. Is there maybe a time we shouldn't be selling the real estate now? Because that was 2 or 3 years ago when interest rates were taking off.
Yeah, it's a
and they kinda
great
peaked
question.
now.
So I think I still like the space. I don't have as much faith in ASB. So I think what we do is looking at managers on a go-forward basis. So I would say let's have the debt manager conversation at the next meeting. You'll still be in ASB and it will incrementally wind down. But over time, I'd like to look at a replacement for them.
So we can take that money and put it in a different.
That's exactly right. I'm not giving up on real estate. We just changed our opinion on ASB.
Rates seem to have stopped the increase.
Yeah, I still like the space, Dan, to just circle back. I still like the space. I just think we may look at other managers instead.
Okay, not to belabor.
No, that's okay.
I'm kind of do any of our funds that we have, they have a position in Bitcoin?
No, that's not considered publicly traded equity, so no.
Or an ETF, which is considered, right?
Yeah, we do not have any positions in Bitcoin at all.
BlackRock has talked about a 2% of interest in black, and of course they're ETFs, I guess, that's what they're trying to sell. Is there a time we should be talking about that?
So plans are talking about it. Obviously, the returns that it's experienced, kind of going back to its inception, are very eye-popping. In Florida, I don't think there's very many plans that have done it. There might be a Miami plan that has done it because there are concerns, because there's not a real good handle on kind of what is underneath that. There's no guarantee. It's not really associated with any sovereign entity. It has, and really there's obsolescence risk as well. There's the chance that it goes to zero. I think a lot of funds have not done it yet, but that may change. With the Bitcoin ETF that you're seeing, now the SEC is involved in regulating. Some of the bigger financial institutions are now holding it. That may change. So I think let me put it this way, we're starting to have conversations. I don't see a lot of plans kind of adopting, but I would be willing to host that discussion as well, kind of a more in-depth conversation on that.
Would be through an ETF, it wouldn't be through actual.
Very likely, because then it becomes the storage and the wallets and all that. And I think one of the big considerations with that is it can be so volatile. We meet quarterly. What happens if it does kind of spike and we want to rebalance? We're not super nimble and kind of able to do that. So those are just kind of the things that we think through, I think, when considering something like that. But the conversations are starting to be had, for sure.
So just to end this thing, could we do a projection or go back? In other words, next time we talk, if we went back to this quarter and had 2% in an ETF, could we see how it would have affected the funds? Can you do that kind of projection type thing of the past without us actually having it there?
Yeah, it would be very short term, but I think everybody probably understands that. But yes, I could. I have to make assumptions. So what I would have to assume is, just to model this, that we're right on top of our target for every asset class, for example. So it wouldn't be perfect, but it would still be a tool that you could use. I'd be happy to do that.
Now, will we have to vote on that for you to do that, or would that be part of your?
No, it's just kind of a request, I think. Obviously, we're not voting to make any changes, so for you to just make the request from my
See some
standpoint. yeah.
numbers if we did do it. Or the, you know, a quarter from now, what it would have done over this quarter.
Yeah. And maybe I'll assume a couple different mixes, like if we took it out of fixed income, or if we took it out of real estate, or maybe I'll kind of show you a few different ways. But yeah, no, that's just kind of an exhibit I could prepare. Yeah, I'd be happy to do that. AJ.
Carrie, you mentioned there may be a Miami plan that's considering Bitcoin. Do you know what plan that is?
I don't. I can tell you I don't believe it's ours.
So that it wouldn't be Miami Beach.
I don't know of any Mariner institutional funds that have done it at this point. I can tell you that on the retail, on the wealth side, which we don't see, by the way, but I hear about, on the wealth side, they have access to Ether and Bitcoin because some of their wealth clients do want that. But on the Mariner institutional side, to the best of my knowledge, there have not been any fundings of any sort of crypto coin, let's say. Some managers in the private equity space, particularly in venture capital, are doing like the blockchain technology. You know, they may invest in people that are iterating blockchain related. We call it like picks and shovels. If you think back to the gold rush, you know, you're not necessarily going after gold, but you're making picks and shovels for those that are. There are some venture funds in the private equity space that may do some blockchain stuff because they see other use cases for it, like settling real estate transactions faster or closing a home on a weekend, or they see other use cases for the blockchain. So I see sort of crypto related stuff on the private equity side, but that's really the extent of it.
Thank you.
Yeah, my pleasure.
What was the quarter return for the fund?
You both were negative slightly, about 20 basis points. So about 0.5% you were down.
Okay.
Yeah, like a slightly negative quarter.
It was crazy toward the end of December. It was like, everything was going nuts.
Yeah,
I was
fourth
sitting there
quarter was a
weighing it
wild
out.
ride,
I was looking
yeah.
for the 31st, and I was like, where did it land? You didn't even know. It's just,
Yeah.
it was odd, yeah.
That day's equity performance could have thrown the whole quarter positive or negative because the S&P was up 2.5%. So it was definitely a wild ride. I think a few of us were sort of holding our breath to see where we were, where we were going to end the year, you know? Yeah, but as of the end of January, I would have you slightly positive, probably 1.5% or 2%, because of the results that we got in January.
So that basically is page 22, upper left, right? That
Yes.
little fund.
I'm going from memory, but I believe so, and I'm gonna get there
Yeah,
right now. I
okay.
believe that should be our right page.
Cool, okay.
Yes, it is up, it's that first column quarter, and obviously, this is the first one in our fiscal year, so they're exactly the same. It's just marginally negative, about 20 basis points.
Cool.
Tell me.
When I look at this report, and I look at fixed income, for 5 years, we've made 1.18%. We've made more money than that in a money market fund. Why do we have $4 million in bonds that never make any money?
So looking forward, the yield on the ag right now is 5%. Your kind of 5-year going forward return is 95% correlated to the yield on the aggregate. So those numbers look backwards, right? And they include 2022 when bonds were negative 18%. Looking forward, the yield on the ag is about 5%. And that is largely responsible for where your performance will come from in the future. So looking back, yes, the numbers look terrible.
Well, even 10 years, it shows 2.27%.
Yeah, we're coming out of a historically low interest rate environment, but looking forward looks much better.
I don't understand how, if we haven't made any money with a $4 million investment in 10 years, how we can feel good about looking forward.
Interest rate levels have changed quite a
I'm
bit.
saying that, they change every year, up or down, but over a 10-year period, they're gonna go up some, they're gonna go down some.
Not by the magnitude that we saw in 2022 and 2023. That Fed hike cycle was at the fastest and most dramatic, essentially, that we've seen. Going back to the Volcker administration.
Well, when I look at this fixed income for all these different years, it never goes over a couple percent on any year.
Going forward, I think you will see that will be comparable with real estate, if not for the next 2 years, slightly better.
Well, how much are we required to have in bonds
I mean,
or fixed income?
so by your policy, the minimum target, your target is 15%, the minimum bracket is 10. But my question to you would be, where would you put it? Like in a market like this where equity valuations are so stretched?
Well,
And
domestic
international,
equity for 10 years has made 11.4%.
the S&P did 20% last year and the year before. Historically speaking, we're due for a reversion to the
Well,
mean.
you can go back to 5 years, it made 11.4. I mean, that's just
I think
That's just my observation.
we're going to enter a very different market cycle going forward than what we've come from. The last
We are,
time,
but nobody knows what it is.
but likely the further away we are from the mean, the more likely I think all else equal that we come back
So you really
to
think we
it.
need $4 million in bonds?
I actually think that segment has only gotten more attractive. It's one of the segments I actually feel better about because we've had 2 years in a row now, and I'm talking 2023 and 2024, where the S&P did 20% or better. The last time that happened was late 90s, and then we had the lost decade. I mean, the numbers are not sustainable. I'm happy because they make our pensions look great and, they help funding statuses, et cetera. But realistically, they're really looking expensive, especially that top 7 now, and I just don't believe that's sustainable. And I don't know when, I'm not calling anything, but I'm saying.
So it's your firm's opinion that the Magnificent Seven is not gonna continue to go up?
Trees don't grow to the sky is one of the things that we say. There's going to be a limit. I think the current pricing with NVIDIA assumes they will double their revenue every year. That's a tall order. Maybe for a couple years they can, ongoing, 10, 15, 20 years. That's a pretty
Well, I
significant
agree with you that
expectation.
they're all overpriced,
Yeah.
but it doesn't seem like the market thinks so.
Yeah, the market can stay irrational
It's
for,
speculation.
yeah, for a very long time, but I just don't think the fundamentals support a whole lot more kind of appreciation there.
What kind of investment do we have in the Magnificent Seven?
So you've got, some of your managers will hold some of them, like Winslow's gonna hold some, they'll do some Microsoft, they'll do some Alphabet, probably Amazon. Most managers are underweight Apple, so you're gonna have some, probably not any Tesla, just because the market capitalization of Tesla is bigger than all the other automakers essentially combined, and that's very hard to justify based on production of cars. So you're going to have some, probably at least 50% of those, your managers like Winslow are going to hold some of. Likely they don't have market weights to those names. And/or they're selling as the prices continue to go up.
Okay.
Yeah, they're not going to hold all of them though, I can guarantee you that. Almost, most of the managers we follow have not held Tesla. They've underweighted Apple, just thinking it's been a long time since Apple's come out with the next best thing. Obviously, they're facing a lot of competition in China, so they're really picking and choosing, kind of based on that list. But in large order, what we're seeing is underweights there, because of the valuations and the assumptions that are going into those sky-high numbers.
Thank you.
So Carrie, we
Yeah.
could, on our own, if we wanted to, punch in the identifier or the
Yes.
quote into Yahoo Finance, for example.
Yes.
It will tell you what the top 10 holdings of.
Absolutely. And the one, if you want to look at Mag 7, it's going to be that New York Life Winslow, MLRSX. That's your only manager I would expect to see those. On the value side, your Brandywine, your Vanguard Equity Income, they're looking for high dividends. That's not going to be your kind of Mag 7. So if you wanted to see, it would be that the New York Life Winslow large cap growth particularly, that potentially could hold some of those.
Any questions, comments, concerns?
Well,
Fire.
Fireside, any questions?
We appreciate it, Carrie.
Yeah, thank you. Appreciate the
Thank you
time
very
very
much.
much.
Thank you.
Just so
Yeah,
wrap that
please,
up if
that'd
you
be
want.
great.
Yeah, Microsoft, 9.51 in that fund, NVIDIA, 8.81%, Amazon, 7.17, Apple, 5.93, so pretty heavily weighted in the magnitude.
Some kind of under and some over. I think Apple's over 10% of the index, so they're under there. They may be over on some of the others. And then kind of Alphabet. I don't know if you see kind of the Alphabet or Meta there or not.
Yep,
They're going to
Meta's-
pick some and they're going to not pick others, Tesla.
Yeah, they're not, top 10's not Alphabet, but it is Meta, and Tesla. And Spotify, which was big today. What it's worth.
Carrie, for our next meeting, could we just kind of go over the investment policy for pension
Absolutely.
plans?
Yes.
Just as is your recommendation as being our expert and advisor, what is best practices
Sure.
for percentage of equities versus bonds versus cash?
Yeah, absolutely.
I think that would be a good summary for us to review as we have discussions.
Good
about
education
Bitcoin.
as well, yes. Yep, I will be happy to host that.
Okay, Andrew's going. Andrew's going to the call. It's 2 bikes, bicycles. There's a call around the corner, or just. Yeah. The 2 e-bikes.
Hey, Pedro,
Yes, sir.
how are you, sir?
Good, good.
Good, I think we're ready for you.
Okay. Well, my report is pretty short. I don't really have anything to report on. I think it's unless you guys have any questions or anything from my end, but
Good talking to you.
it's no news from your attorney is always good news.
That's
Right,
awesome.
Debbie's got a question.
How's our summary plan description coming?
I'm sorry, Debbie. I couldn't hear you.
How's our summary plan description coming?
Oh God. I apologize. I thought we had gotten it over to you guys, but I'll get it over to you guys, and then you guys can have it on your agenda for the next meeting. I apologize.
Okay, thank you.
Yep, absolutely.
All right. I think that's it.
All right, guys.
Thanks, thank you.
Adjourn?
Yeah. Get a vote to adjourn. Oh, Bill's got a question.
No, not for Pedro, just
Okay.
for these guys.
All right.
I don't know if Joe's able to make it Friday. I don't know if that's a proper discussion about that now, or?
Probably not in front of fire, right?
Okay.
Because you're not making a motion.
Yeah.
It's just-
I think any discussion with respect to the disability application, we should wait until the special meeting.
Okay.
Yes, sir.
I think the only question was.
Yeah, the only question I had was,
I'm happy. I'm happy. I apologize. I didn't mean to cut you off. I'm happy if you want to give me a call and we can talk offline. Happy to do it. I would just prefer it that way and avoid kind of the public discourse, just because we haven't put it on the agenda. We didn't really advise him that we were going to be discussing it. So just in the utmost caution, I think it's just best that we would hold off today, communally having the discussion. But I'm happy to, whenever you need, just give me a call, and I'm happy to talk through it.
Okay, we appreciate the guidance, and we're gonna give you a call.
Yep. Yeah. Perfect.
All right. All right. You have a motion to adjourn? Aye.
aye.
Motion to adjourn?
All right, guys.
Motion.
Oh, sorry.
Second?
All in favor?
All right, we're good, Pedro.